They told you gold is obsolete. They said it doesn't yield, it just sits there. It can't innovate, it can't disrupt. Meanwhile, the most powerful institutions on Earth, the ones that don't chase trends, the ones that think in decades, have been quietly hoarding it and bringing it home. Why? Because when trust in a monetary order starts to crack, central banks don't argue on television. They move metal. They don't hedge with slogans. They hedge with vault doors. This isn't a commodity story. It's a power story. When empires argue in public, central banks answer in gold. Here's the blueprint most people never see. In every era, when a paper promise is questioned, the system tries the same 4 moves. First, price management. Peg the price, manage the optics, project stability. Second, coercion. Redefine the rules, confiscate where possible, change convertibility. Third, official sales. Push supply into the market to dampen the signal. Fourth, the reversal, accumulation and repatriation as institutions admit, silently, that gold is not a trade but an option on sovereignty. You're about to ride a time machine through the quiet wars that shape the money in your pocket today. The pattern isn't perfect, but it rhymes enough to map the road ahead. We begin in 1933-1934. The United States is drowning in deflation, bank runs, and collapsing confidence. On paper, the dollar is defined by gold. In reality, convertibility is fiction if the system doesn't have enough metal to honor its promise. So the rulebook bends, the government makes private gold illegal to hoard, compels surrender at a fixed price, and then, this is the crucial part, revalues the metal higher on the state's balance sheet. Overnight, the anchor moves, not because geology changed, but because the monetary foundation needed a bigger keel to keep the ship upright. In a crisis, you don't print gold, you redefine gold. That is move number 2 in the playbook. Coercion coupled with revaluation. It is how a paper system borrows sturdiness from a metal it cannot produce. Fast forward to the 1960s. The world is on Bretton Woods rails, the dollar is convertible into gold at $35 per ounce, and the other major currencies are pegged to the dollar, but the math is drifting. The US is spending abroad, running deficits, exporting dollars faster than it is mining gold. Foreign central banks can see the mismatch. Confidence is a currency too, and it's leaking. Enter the London Gold Pool, an alliance of Western central banks to dump official gold on the market whenever the price threatens to rise above the peg. This is move number 1, price management in the open. It works until it doesn't. Physical demand keeps chewing through official stockpiles, and in March 1968, the pool snaps. You can manage optics, you cannot repeal arithmetic. When a peg asks you to sell more metal than you will ever be willing to part with, the pool dies, the curtain falls, and the audience realizes the magician was working with mirrors. 3 years later, the pretense ends. In August 1971, the U.S. closes the gold window, severing the dollar's convertibility. Gold is unpegged, and for the first time, modern money is based not on metal, but on faith. Faith in a government's future capacity to tax, in a central bank's confidence game, in a bond market's patience. The price of gold does what suppressed truth always does. It rushes to fill the space left by denial. 35 becomes 70, 70 becomes 180, 180 becomes 800. The move is not a surprise if you understand the pool's collapse. Price management failed, convertibility ended, so truth had to be repriced. The metal did not become more useful. The promise became more revealing. Gold did not shout. Paper confessed. Now watch the pendulum at the end of the century. With the memory of the 1970s fading, growth strong, and inflation subdued, many central banks decide gold is dead weight. It doesn't yield, bonds do. It doesn't fit modernity, derivatives do. So they sell. They announce sales, coordinate ceilings, and write academic papers about opportunity cost. This is move number 3, official sales to dampen the signal, to validate the narrative that gold is an anachronism. It's hard to resist a story that says you've evolved beyond the past. But markets have a dark sense of humor. The most aggressive sales occur near cycle lows. A decade later, the institutions that once mocked gold quietly begin to buy. The pendulum never stops, it just swings slower at the extremes, which brings us to the 2010s and 2020s. Something changed after 2008, and it wasn't just interest rates. The world watched the machinery behind the curtain. Bailouts, Quantitative easing, yield curve engineering, balance sheets that expanded until the axes on a chart had to be redrawn. For a while, that machinery worked, but trust is a muscle. Overuse it and it tears. Sanctions policy then introduced a new variable. Reserves could be frozen with a signature. Suddenly, foreign exchange reserves and government bonds carried not only duration and inflation risk, but political seizure risk. If you're a central bank outside the core, you learned a loud lesson. Your rainy day insurance can be locked remotely. Gold cannot be frozen on a foreign server. It can only be taken if it's stored where someone else controls the keys. So the quieter move appeared on shipping manifests: accumulation and repatriation. That's move number 4. No press conference, no victory lap. Just metal moving from somewhere else to home. This is the secret gold war. Not artillery, not carriers, not sanctions headlines, but subtle signals. An uptick in official purchases, vault projects, tweaks to custody language, bilateral settlement experiments that whisper a simple truth. Whenever trust in paper erodes, settlement migrates toward things you can touch. You're watching two philosophies crystallize. On one side, paper and promises, a faith that digitized credit money, flexible balance sheets, and swift policy can tame any storm. On the other, metal and molecules, a belief that real assets, gold, energy, food, strategic metals, are the only collateral that transcends jurisdictional whim. You don't need a conspiracy to understand why both exist. Paper is fast, scalable, indispensable for daily commerce and credit flow. But when nations settle scores, when sanctions bite, when stockpiles matter, they don't ship spreadsheets. They ship tons. That's why gold still sits on central bank balance sheets in 2025. Why it appears in footnotes you never read, why it is carried at comically low official values in some books, even as those same institutions build new vaults. If gold were as obsolete as the marketing says, repatriation would be a tourist stunt. It isn't. It's a sovereignty project. You don't bring home what you don't plan to rely on. Let's be precise about the tools in this quiet war. Price management today is less about meeting in smoke-filled rooms and more about derivative structures, leasing, and term flows that can massage the curve. That can damp volatility, that can tether perceptions, but derivatives ultimately cash settle against a reality measured in kilograms. If the offtake from refineries and mints persistently runs ahead of official flows, if bids in the physical market won't yield to the paper tide, basis spreads tell the truth. The market's long memory is stored not in tweets, but in the premiums people quietly pay over screen prices when they need actual bars delivered to actual vaults, with chain of custody that can withstand a state audit. Revaluation risk is the second tool, and it's the move everyone pretends is unthinkable until it becomes inevitable. A system reaches for revaluation when balance sheets need repair that interest rate tweaks cannot deliver. Revalue the metal on the state's books, and suddenly the collateral backing your liabilities swells without the messiness of a default. It's not new, it's simply impolite to discuss. This is not a forecast that tomorrow morning someone will triple the official price of gold. It's a reminder that constitutions and statutes bow to reality when the gap between promises and resources becomes politically untenable. The last resort is often a redefinition of the unit, and gold is the mirror used to justify the new reflection. Capital controls are the third tool. The language changes from era to era, but the melody is the same. Stability. Financial safety. Anti-speculation measures. Controls may start with booking rules and reporting standards. They can escalate to movement restrictions on bullion, attention at borders, or taxation designed to chill private flows. None of this means you wake up to jackboots and seize orders. It means the path of least resistance is always to keep the collateral where it's easier to draft. If a state's planners decide it needs more gold inside its walls to cushion a reset, the policy options exist and the narrative will be ready. The last 20 years have proven how quickly exceptional measures can become normal. The fourth tool is settlement drift. You do not need a classical gold standard to shift power. You only need a few major commodity providers to require, at the margin, better collateral for long-dated deals or to settle a slice of trade in a basket that includes metal. It can start with energy or critical minerals. It can be framed as risk management in a fragmenting world. But if that drift takes root, the hierarchy of money changes. The assets closest to the settlement layer rise in status, while assets living far above it, further out the risk curve, become more sensitive to mood. Watch the infrastructure, vaulting capacity, assay standards, clearing arrangements, and the rise of bilateral agreements that name specific deliverables rather than abstract indices. That's the plumbing of a new order built without a speech. What would the next breakpoint look like? Not a movie scene, a sequence. First, persistent stress where the metal actually moves, shortages of specific bar formats, long lead times, premiums that refuse to mean revert. Second, a change in rhetoric from barbarous relic to strategic reserve. You'll hear the euphemisms sharpen: resilience, redundancy, diversified settlement. Third, repatriation accelerates. A nation with no public affinity for gold suddenly announces a domestic custody expansion on logistical grounds. Fourth, a crisis that politicizes reserves, sanctions escalation, a blockade, a default, catalyzes a headline decision. A bilateral settlement pact that mentions collateral in a way it didn't last year. Price will respond, but more important is the shift in behavior that follows. Think of it like weather. The rain is the price. The climate is the settlement regime. This is where the digital debate usually enters. What about cryptocurrencies as the neutral settlement layer? At the retail layer, for individuals and firms, the technology is clever, the rails are useful, and the use cases exist. But at the level where central banks operate, neutrality isn't just a code base. It's jurisdiction, the power grid, legal controllability, and the capacity to weaponize or immunize. Gold has one primitive advantage. It's apolitical matter. It does nothing. It yields nothing. It depends on no server and no patent. That uselessness is its superpower in a world where everything else is someone else's liability. This is not an insult to digital assets. It's a category distinction. For daily life, speed matters. For final settlement between rivals, indifference matters. So where are we now? Official purchases have been positive for years, not spectacular every quarter, but patient, consistent enough to sketch a trend line. Repatriation has moved from rare headline to routine maintenance. The sanctions era has made it fashionable to talk about friend-shoring and de-risking, but those are polite phrases for the same underlying instinct. Reduce dependency on the goodwill of someone else's institutions. If you sit in a finance ministry outside the core, you don't need a manifesto to see the appeal of metal in your basement over a promise in someone else's database. If you sit inside the core, you don't need a conspiracy theory to prefer that the periphery keep trusting your paper. This is the quiet tension shaping the next map. The stakes are higher than price charts. If the secret gold wars intensify, bond markets change character. Not because bonds vanish, but because the marginal buyer's calculus shifts. If more settlement demands hard collateral at the edges, sovereign debt in the middle must offer either more yield or more control to compensate. Either path has consequences. More yield crowds out other priorities. More control narrows the optionality of private capital. Equity markets won't disappear, but their discount rates and narratives will live closer to geopolitics than most investors have been trained to tolerate. And currencies? The reserve status of any unit rests on three legs: network depth, military reach, and the world's belief that your legal system is a predictable place to park risk. If any of those legs wobble, the quiet question becomes, what collateral convinces a counterpart to still trade with you on your terms? You already know the oldest answer. None of this requires a crash tomorrow morning. You do not have to predict collapse to read a map. The map says that when central banks buy quietly and bring metal home, they're not chasing returns. They're buying options on sovereignty, options on the ability to say, we can pay in something you cannot freeze, options on negotiating leverage if the rules of the game are rewritten under stress. You can disagree with the wisdom, you can argue the cost, but you cannot ignore the signal. The institutions closest to the core of the system are positioning for a world where paper debates last longer and metal ends the conversation. Think about how the last century's turning points actually felt. 1933 didn't feel like history to people standing in line at the bank. 1968 didn't feel like destiny to the men in those rooms in London. It felt like a stubborn market. 1971 didn't feel like the end of an era. It felt like a temporary measure. Every temporary measure that redefined money came dressed in the costume of necessity. That's why you will not be warned with a siren. You will get memos about stability, statements about modernization, reviews about best practices. The vault truck doesn't honk when it backs into a loading bay at night. There is one more uncomfortable truth. The playbook includes the possibility that private gold becomes inconvenient to policymakers at exactly the moment it becomes most useful to citizens. History doesn't repeat perfectly, and modern democracies are not ancient empires. But the instinct of states under stress is timeless. Secure the collateral, silence the signal, control the exits. If that instinct reappears, it will be framed as fairness, as national unity, as leveling the playing field. You don't have to cheer it or fear it to acknowledge that it sits on the shelf as a policy option. Understanding that is not cynicism, it's adult literacy in monetary history. Where does that leave us? With a simple lens, when you see official sales, ask, what narrative is being defended? When you see accumulation, ask, what risk is being acknowledged? When you see repatriation, ask, what trust is being reclaimed domestically? When you hear that gold is obsolete, ask why the speaker's institution still carries it, still insures it, still teaches young staff how custody works. Gold is not a religion, it's a game piece. In times of easy trust, that piece sits on the edge of the board gathering dust. In times of contested trust, that piece moves to the center and decides outcomes disproportionate to its daily utility. If the secret gold wars escalate, the next monetary order will not be authored by a press conference. It will be assembled in hallways, in bilateral contracts, in minutiae, inside clearing documents that specify what counts as good delivery. It will be enforced by those who control energy and materials and secured by those who can promise settlement in things that the other side cannot cancel. The chart will lag the plumbing. The headline will lag the habit. The story will be told years later as if it arrived in a single weekend. It never does. You don't need to become a doomer to respect this. You only need to accept that empires are loud, but settlement is quiet, that speeches move crowds, but tonnage moves history, that paper organizes the world, but metal closes the book when arguments run too long. In the end, the oldest monetary phrase will matter again, not for individuals stacking coins under mattresses, but for institutions that must guarantee food crosses, oceans, and fuel crosses borders. Final settlement. If you strip all the drama away, what remains is a question. If gold is obsolete, why are the people who run the system treating it like the only thing that matters when things break? If the answer is habit, ask why the habit is growing. If the answer is insurance, ask what risk they're insuring against. If the answer is optics, ask why optics require vaults. The map is drawn in quiet lines, and the next time the world argues about which paper should sit on the throne, the real vote may be counted by weight. You do not have to predict a collapse to read this map. You only have to decide which side of the settlement layer your nation will stand on, paper and promises, or metal and molecules. One builds speed, the other buys time. In a benign world, paper wins. In a contested world, time is everything, and time is what gold has always bought for the institutions that cannot afford to be wrong when the lights flicker. That is the secret war you were never meant to notice. It does not trend. It does not cheer. It does not shout. It hums beneath the headlines, moving bars beneath cities you will never visit, repositioning the fulcrum on which currencies balance. If it continues, the next monetary order won't be decided on a trading floor. It will be decided in vaults. And if that day arrives, the loudest people will turn out to have been spectators. The quiet ones will already be seated.